company or trust, we've got a special provision, Section 23K, which says a personal service provider cannot deduct anything except the following. So 23 is basically saying no deductions except what is allowed. So the only deductions that they can deduct is salaries and wages paid to employees, who include that in their taxable income, legal expenses, bad debts, contributions to funds for the benefit of employees, refunds of amounts previously paid as remuneration or compensation. And this is probably the one that most people really want to look at, especially if you have got a CC that is owner managed and you don't really have a lot of employees. What are your expenses? Typically going to be rent, motor vehicle expenses, stationery, things like that. Well, the only thing you can deduct is expenses in respect of premises. There's your rental. Finance charges, if you've raised loans to buy your motor vehicle or, run your business, etc. Insurance, repairs, and fuel and maintenance of assets if the premises or assets are used wholly and exclusively for purposes of trade. That is, wholly and exclusively means 100%. Means what it says. Not 90%, not 99%, 100%. So the thing is, if this person is working from home, all right, and that asset that they're using, the property, is not used wholly and exclusively for purposes of trade, then you're going to be very limited in terms of what you can deduct under this provision. Now, if you're renting office space and you're paying rental on that office space, and pretty much you'd be using that office space wholly and exclusively for purposes of trade, then obviously you can deduct the rental that you pay, all right? So it's expenses in respect of premises. You can deduct the insurance premiums on the insurance cover that you have over your assets and premises. You can look at repairs and fuel and maintenance of assets, all right? So if the leg falls off your desk and you have it repaired, yes, you can claim that because the asset is used wholly and exclusively for purposes of trade. But that's it. So then what about stationery, tea and coffee and all that stuff? It's not covered there, all right? Because this is very specific. It is limited to what is specified there. And so that's what I say, if you label it as a PSP, the employee's tax aspect is actually the least of your worries, because that's just a temporary cash flow problem. This is a permanent problem in that you can't deduct these expenses, okay, ever, as long as you are a PSP. Now, it's possible, obviously, that you could be a PSP one year and then not a PSP the following year. If you've now got your 3 or more employees and you're no longer a PSP, then these provisions no longer apply to you. And that's also another thing to watch out for, is SARS might tend to keep taxing you as a PSP because once upon a time you were. So you need to have a look and see, in this particular tax year, maybe this is no longer a PSP and mustn't be taxed as a PSP. All right, you're back to the normal rules, you get your tax deductions, etc. Okay, so PSP, quite a dangerous category to get into. Then the third one that we want to look at is labour brokers. This is probably less prevalent, especially following this change a few years ago, where labour brokers now, in terms of the definition, the 4th schedule, is only a natural person. So when we talk about labour broker, in this context of a labour broker falls into the definition of an employee, then it's only natural person labour brokers. If it's a company that's carrying on the business as a labour broker, that does not come into the definition of employee. So they're not subject to employees tax, and they're not subject to these other provisions either. So it's a natural person who carries on the business of providing clients with people, etc. And essentially, you'll see just now, it's a person without the labour broker's exemption certificate. So again, interpretation note number 35 gives guidance on this. And the tax treatment, if you are a labour broker, you're an employee, the employee's tax has to be withheld. And again, you'll see here, section 23K, that limitation on deduction of expenses, the same thing comes through. So again, you can't deduct any expenses other than what was listed. But notice here that this talks about a labour broker without an exemption certificate. Okay, so pretty much you want to get yourself that exemption certificate, but sometimes that's easier said than done. Let's see if I can just get this. Okay, so the certificate will be issued by SARS if you carry on an independent trade, registered as a provisional taxpayer. Well, of course, one doesn't really register any longer, but you must submit your provisional tax returns, registered as an employer, and you're up to date with all your returns. Then SARS will effectively look at giving you that exemption certificate. Okay, and as I say, that is key, because without that exemption certificate, you're going to end up with a rather nasty tax situation. Notice here that SARS won't issue that exemption certificate if more than 80% of your income essentially comes from one client, again, unless you've got 3 or more employees. Or if you provide the services of another labour broker, or you're contractually obliged to provide a specific employee to the client. Okay. Do any of you deal with labour brokers in this context, not companies but individuals? I get the sense it's not really something that, you know, one comes across terribly often. So let's move away from that onto something that you do come across a bit more frequently, and that is your home office expenses. Now obviously a lot of people work from home, whether they're working as a sole trader or they have a company, closed corporation, that is using an office within that person's home. And there's a lot of tax implications that flow from that. I know the first thing people tend to ask when there's a home office involved, what about the CGT implications? So let's just talk about that quickly. I mean, the issue is that if you have used part of your primary residence for business purposes, a lot of people, maybe it's changed now, but for a long time people seem to be under the impression that you lose the primary residence exemption. Now you don't, that's all right, but the issue is that if you've used, say, 10% of the house as office space, when you sell that house, assuming that you've used the rest of it as your primary residence, when you sell that house, you're going to work out your capital gain on the whole house, proceeds minus base cost for the whole house, and then you split that capital gain, the 90% that relates to the primary residence and the 10% that doesn't, the 10% that relates to the area used for business purposes. Then you take your primary residence exclusion against that portion that was used as a primary residence, and that other 10% portion of your CGT is not subject to the exclusion. That carries through. Okay, so that's really the adjustment. So it's not that you lose the exemption altogether. But what I wanted to focus on here is not so much the CGT aspect, but the deduction that you get on an ongoing basis, year by year. Now, I was saying earlier that Section 11 talks about what you can deduct for tax purposes, and Section 23 sort of works against that and says, but there's some things that you simply can't deduct, like private expenses. However, Section 23B does say that although you can't deduct private expenses and expenses related to your household, you can deduct home office expenses related to a trade if part of the home is occupied for purposes of trade and that part is regularly and exclusively used. That's the first one, regularly and exclusively used and specifically equipped for the purposes of trade. All right, so you need to have an actual office, assuming that you're doing office type of work. I mean, if you're doing workshop kind of work or whatever, then you've got to have something suitable for that. But let's assume you're doing office kind of work, then you need to have an actual office in your home. You can't be sitting on the bed with a laptop on your lap, because that's not really suitably equipped for purposes of trade. Okay, so it's got to look like an office, and it must be regularly and exclusively, again, exclusively 100% used for purposes of trade, which I think might get a bit difficult in practice, because, you know, does that mean that no one can ever set foot in that office and play computer games on your computer, or, you know, send private emails and things like that? Well, I think, you know, one also has to be a bit realistic about this. But what we are saying is that it's not used as a guest room for sort of 6 months of the year and a little bit for office as well. It's demarcated as an office, and it's essentially exclusively used for business purposes. Okay, and if you're an employee or holder of office, then you've got to think about something else, because Section 23M, another sort of provision that says you can't deduct. 23M essentially says that if you're an employee or the holder of an office, you can't deduct anything other than your sort of pension, etc., etc. But it does say that you can deduct home office expenses if more than 50% of the income from employment is derived from commission or other variable-based payments based on work performance, etc., etc., and the duties are not performed mainly in an office provided by your employer. All right. Not performed mainly in an office provided by your employer, so you mustn't spend more than 50% of your time in an office provided by the employer. So you must spend less than 50% of your time there, and the rest of the time you're spending outside that office. It doesn't mean you have to be spending it in your home office. You could be in the car as a traveling salesman, traveling around trying to sell whatever it is that you're trying to sell. Okay, because you're deriving more than 50% of your income from commission. So you're going to be out there on the road trying to sell stuff, as long as you don't spend more than half the time in an office provided by your employer. Or alternatively, so this is if you don't get more than 50% of your income, so you're just a regular person, you're not a commission earner, but if your duties are performed mainly in that part of your home. In other words, your employment contract says, for whatever reason, you have to work at home, and more than 50% of your work has to be done in your home office. Okay, duties are mainly, more than 50% of your duties must be performed in your home. So on the one hand, if you're a commission earner, you must just spend more than half your time out of the office, your office, all right? And if you're not a commission earner, you must spend more than 50% of your time in your home office. All right, so it gets a little confusing. All right. There is a nice SARS interpretation note number 28, which talks about home office expenses, what qualifies, and then also gives you a nice list of examples of what would qualify as home office expenditure. But essentially, I think that the measure really is to say, if you were renting premises, you would be deducting everything related to the rental of those premises, all right? You'd be looking at everything related, as long as it, of course, meets the general deduction formula, expenditure incurred in the production of income, etc., not of a capital nature. You'd be deducting all of those expenses. So to the extent that you have any of those expenses incurred in your home context, you should be deducting those expenses. But now, of course, the thing is that you might be paying, for example, electricity for the whole property, rates and taxes for the whole property, whereas your office is only 10% of the property. So it stands to reason that you would be apportioning a lot of those expenses, and that's entirely permissible. So you would apportion, and if you're looking at rental of the premises, if you have bought the house and you've got a bond, it's not your bond repayments that you claim, it's the interest on the bond. Okay, so just be careful about that. Cost of repairs to the premises or your actual business assets, obviously that will also qualify for deduction, and any other expenses connected with the premises. So you've got to paint the walls, you've got to fix the lights, all that sort of thing would qualify for deduction. And then it can also include phones, stationery, rates and taxes, cleaning. So all these examples are given in the SARS interpretation note, and it stands to reason. Of course, then people start asking, can I claim the cost of my gardener and all that sort of thing? And it really comes back to the issue, does that expense relate to the home office, and comes back to the core question, expenditure incurred in the production of income, not of a capital nature, etc. All right, so in the course of trade. So if you're incurring this expenditure as part of your trade in the production of income, then yes, it will qualify. But if your office is sort of in one section of the house, walled off, paved driveway, you get the impression no garden, in other words, all right, the gardener never comes in there, then it would be incorrect to deduct some of the gardener's expenditure, because nothing he does is related to the business. So one has to take a view on it. What relates to the business? That is what you can deduct. Okay. Okay, let's see. So we've got a nice little example here from the interpretation note, and what we're showing here is essentially somebody who's got commission and salary and travel allowance, and you can see immediately that the commission income makes up more than 50% of his total remuneration. So what we're saying there is that he's not subject to section 23M because he's a commission earner. And then remember that his home office expenditure he can claim as long as he's spending most of his time out of the office provided by the employer. All right, so he's contracted to work from home, he maintains a home office, he uses it regularly and exclusively, performs his duties mainly in that home office. Then, of course, the question is, what is the area of the office in relation to the house? And we work that out at 10%. He buys certain assets, computer, office desk, office chair. Of course, the computer is more than 7,000. These other assets are less than 7,000. So he'd be looking at your wear and tear allowance on the 12,000 and a full deduction on those assets over there. Interest on the bond, rates and taxes, and he contributes to a pension fund. Now, I mean, it's a very straightforward example, but it's just to illustrate the point that the interest interest on the bond, rates and taxes, that is for the property as a whole, so he would only deduct the portion that relates to his home office. When he looks at pension, he's going to deduct his pension fund contributions. That's not related to his business, and he gets the pension deduction anyway. And as I mentioned about the wear and tear, his commission-related business expenses of 9,000 Rand, he would be allowed to deduct that. So you'll see all of that coming through in the result. Yes.
What if the property is fully paid for?
Okay, yeah, if the property is fully paid for and there's no interest on the bond, and he's running his business as a sole trader at home, then there's no deduction there, because you can only deduct for expenditure actually incurred. So if you're not incurring interest on the bond. The reason why I make that point is because if you had a separate entity, I was saying as a sole trader, let's say that you're operating as a company or closed corporation, you could potentially enter into a lease agreement between the owner of the property and the company, whereby the company pays rental. All right, and then you could deduct that rental, regardless of whether there's interest on the bond or not, because now you've got a separate contract for the payment of the rental. Does that make sense? But of course, the thing is, you paying rental to the owner of the house, he must include that rental income in his gross income. So, you know, it's in and out. Yeah. But some people do like to make that arrangement. The only thing is, be very careful. You've got a properly documented, proper lease agreement and all the rest of it, as if you were doing it as a third-party arrangement. Okay. All right, so there's the result over there, and I think, you know, everything's pretty self-explanatory, that he would claim all of those various deductions. Just before I go on to provisional tax, let me just pause for breath there and just see, are there any questions around home office expenditure that anyone wants to ask? Yes.
The agent, I think it's a state agent, who has an arrangement for the rental to be paid to CC. She receives the income as such from home. She works from home.
Yes.
That would be income in her hand.
Yes.
She then be able to claim all those deductions against that particular income.
Okay, so we've got an example where the person has a CC. The CC rents the office space from the individual who owns the house. Yes, so the issue there is that the CC will claim the rental as a tax deduction. The individual must include that rental and will claim the related expenditure as a deduction against that rental. But now it's the individual who brings the whole rental into gross income and then claims the related expenditure incurred in earning that rental income. They will claim as a tax deduction. I know I was dealing with a question a little while ago from somebody who said they paid the rental and then for whatever reason the company still claimed all those costs of maintaining the property, etc., which makes no sense to me. Because if they're renting, you've got to think, what would a normal lease agreement do? A normal lease agreement says you pay your rental, the landlord must look after the property, and they must claim all the expenses related to looking after the property. So you must try and get it as closely aligned to a normal arm's length transaction as you possibly can. Okay. Yes.
Charles Cecil in the webinar asked, does a company paying a PSP have to withhold the PAYE before paying the PSP?
Yes, okay, so the question, a client paying a fee to an entity that falls into the definition of a personal service provider. The personal service provider is an employee as defined and is subject to employees' tax. So the client paying that PSP must withhold employees' tax before paying the PSP. So, and then must issue the respective tax certificate at the end of the day so the PSP can claim the tax credit for the employee's tax. Yeah. Okay. All right, let's move on to provisional tax then. All right, so provisional tax is just a topic that just keeps coming up year after year after year. And whenever I ask people, you know, what types of topics would you like me to cover in this seminar, inevitably provisional tax comes up. So let's go through it, because I know that the rules are quite complex, and to make it a bit more complex, they keep changing. All right, but the good news is that they haven't changed in the last year, as far as I can recall just off the top of my head. But I think we're pretty secure on that one. So at least they haven't changed. But let's have a look at it. So who is a provisional taxpayer? We've got a definition in the fourth schedule that says any person other than a company, so you've got individuals effectively, who derive income other than remuneration or a Section 1 allowance, which is your travel allowance or public officers allowance. Okay, so anyone who's getting any income as defined other than remuneration or travel allowance. So if you're getting rental income, if you're getting interest income, etc., that's income other than remuneration. Any company, note any company. Company includes closed corporation. So you are a provisional taxpayer if you're a company or closed corporation, and any person who's notified by the Commissioner. That just leaves it kind of open for SARS to nominate, yes, you are a provisional taxpayer. So where does trusts come into this? Well, a trust is a person other than a company, so if the trust earns any income other than remuneration, then they must be a provisional taxpayer, which is probably going to be the case, because your trust is probably going to be earning interest income, rental income, whatever the case might be. Okay, there are some exclusions. PBOs, recreational clubs, body corporates, share blocks, etc., which are pretty much exempt from tax. And then persons exempt from provisional tax under paragraph 18. And this is where things start getting a little bit more